It's official. The Federal Reserve is now likely to cut interest rates by 50 basis points at this week's Fed meeting. Markets are actually pricing in a 60% chance of a 50 basis point cut and only a 40% chance of a 25 basis point cut. And on this, we need to talk. We do have some important economic data coming out tomorrow that will influence the probabilities of 50 or 25 basis points. And the Fed already knows what that retail sales number is going to be tomorrow morning. If it comes in on the soft side, weak retail sales data, you're more than likely going to see the odds of a 50 basis point cut rise. If that retail sales number comes in strong, showing the economy is not falling out of bed, if you will, then the odds of a 25 basis point cut are probably going to get priced back into our markets. So theoretically, if retail sales are going to be strong tomorrow morning, but the Fed maybe still wants to do 50 basis points, you're going to see a new article from Nick Timiraos coming out probably tonight, if not tomorrow. So be on the lookout for Nicky leaks coming over the next 24 hours. Again, if you're watching this video, you are probably invested in equities. So what does this mean for stocks? Well, in the short term, Fundstrat and Tom Lee as well as Mark Newton say the S&P and triple Qs are approaching short-term resistance. The SPY chart showing its bullish advancing triangle pattern is shown below. The area near 565 certainly looks like an important area for S&P and should provide strong resistance ahead of some minor consolidation. So Fundstrat does not believe we are going to see a sell the news event coming this week following the first Fed cut. But a lot of people on Wall Street do think we are going to see a sell the news event, including myself. Because the simple fact of the matter is, stocks are trading near all-time highs. The last time we had a rate cut with stocks trading at all-time highs or near all-time highs was August 1st, 2019. The S&P sold off 7% in 4 trading days. A direct sell the news event took place. And on August 1st, 2019, that was only a 25 basis point rate cut. So perhaps a 50 basis point rate cut further solidifies the potential for sell the news. Because on one hand, 50 basis points is seen as good news. Lower borrowing cost is good for companies, it's good for people, it's good for consumer spending behaviors. On the other hand, is the damage too far done or too far gone if the Fed needs to cut 50 basis points at the first Fed meeting? Unfortunately, we won't know the answer to that until we get more economic data and until the federal funds rate is getting back to more of a neutral place. We also have a lot of other factors to consider as well, like the upcoming election, which is 8-ish weeks away now. That has not got priced into markets. The outcome of that election on both sides has negative political ramifications, whether you're talking about tariffs or a higher corporate tax rate. Both of those policies are going to affect EPS estimates for next year. At the same time, EPS estimates for 2025 are still trading at, or they don't trade, but they're sitting at all-time highs, which means you're basically still priced for perfection. Now, as well as that, just worth knowing that the best sweet spot during a hiking or cutting cycle is not during the hikes. Clearly, we've seen 2022 as a really bad year. It's not when the Fed cuts rates. It's actually after the last Fed hike. So that was July of 2023, before the first Fed cut, which is going to be this week, September 18th. So the last 18 months or so was really the historical sweet spot for equities. This is historically the period in time in which stocks tend to do very well. And this makes sense, right? If the Fed's not hiking rates anymore, inflation is probably coming down. If the Fed is not cutting rates, then the economy is probably still doing okay, because when the economy starts to do worse, the Fed will cut rates. So you're really in that sweet spot of things are getting better and on the inflation front, and the economy is doing okay. And again, when the Fed starts to cut rates, there's either a problem or a soft landing, which there's been a lot more problems than soft landings in the past. So judging off of historical context, When the Fed starts to cut rates is when people tend to panic. Even if this time is really different and we're going to get a soft landing, I wouldn't be surprised to see a little bit of, I'm going to take risk off the table upon the first Fed cut this week. Now, again, I would like to point out something that Tom Lee and Fundstrat have said extensively over the past couple of weeks and months. A 25 basis point cut or 50 basis point cut is not necessarily bearish in and of itself. You could have a bearish 25 basis point cut or a bearish 50 basis point cut, or vice versa, or a bullish 25 or bullish 50. It all depends on what the dot plot says. We're going to get a new dot plot, and it depends on the tone of Jerome Powell. Now, this is the last dot plot that we had. You get GDP projections, unemployment projections, inflation projections, and the federal funds rate projections. Now, these are only projections, and they can be wrong, and the Fed is notoriously wrong on these dot plots. But the simple thing you guys need to keep in mind, the stronger the economy, the stronger the markets. The weaker the economy, the weaker the markets. No matter how many cuts were projected to get from the Fed. So for an example, if the GDP projection goes under 1% from where it was in June at 2%, if the unemployment projection goes up to like 4.7, 4.8, 4.9, 5%, it doesn't matter how many cuts the Fed says they're going to do on the dot plot. The markets will freak out because that means quite a bit more weakening in the economy. And then what does that mean for EPS estimates in our markets? With EPS estimates at all-time highs, the two really are not lining up at that point. But for an example, if the Fed gives us a 50 basis point cut and they barely move their estimates, let's say GDP, they take that from 2% down to 1.8%, they take the unemployment rate up to 4.3%, something pretty benign in nature, but they forecast a lot more rate cuts and lower inflation, the markets are going to take that as very positive. That is the dovish potential outcome of this Wednesday. Again, the hawkish potential outcome is Jerome Powell that sounds like a recession could be coming. He's cautious around the economy, thinks there could be more weakening in the labor market, and they take down their estimates for GDP, raise their estimates for unemployment, and really it doesn't matter what they do with their federal funds rate projections. So yes, there is a bullish and bearish potential outcome for this Wednesday, no matter if you get 25 or 50 basis points. You could see a 50 basis point cut, and that could still be bullish because it's not about the size of the cut necessarily. It's about the strength of the economy or the projected strength of the economy from the Fed. Now, it's actually interesting. What you've seen over the past couple of trading days is, yes, the S&P has recovered a lot. It fell 4.5%. It went up 4.5% in September. And now you're sitting about 1% away from new all-time highs. But what's most interesting is if you look at the RSP today, this is the equal weight S&P. It's hitting a brand new all-time high. It's up 0.56%. The S&P is down 0.1%. The equal weight S&P is actually outperforming. The areas of the markets that benefit from rates falling are outperforming. And these are the areas that have been unloved, that have not participated in our markets. These are cyclicals, value, dividend stocks, small caps. These areas have not done well in the last couple of years. And you can see that here. The Dow is up 1/3%. The Russell 2000 is up 0.02%. The Nasdaq's down almost 1%. This is directly a move in markets to position for what will benefit from rate cuts, which I don't think this necessarily tells you like markets are going to go up or down on Wednesday, but it is telling you that if we do see a bullish reaction in markets, Wall Street is positioning for it. Now, again, with a lot of these sectors, cyclicals, value, dividends, small caps, pretty well already priced for a recession, the risk to reward heading into this Wednesday for those areas is a lot better than, let's say, big tech that actually stands to not benefit from the Fed lowering rates. In fact, as I've talked about many times here on this channel, big tech has benefited from rates staying, quote, higher for longer because odds of a recession go up. these big tech stocks are well diversified. A lot of these companies do enterprise to enterprise business more than direct to consumer. These are not really discretionary products or discretionary categories. They are categories that companies need or people need, thus why they're multi-trillion-dollar companies. These companies also have a lot of cash in the bank, if you will. So they're collecting a lot of interest as rates stay higher, and that is really artificially boosted profitability. You also have the AI hype concentrated in these big tech stocks. And as you would expect, Apple's down 3% today, Nvidia's down 2.5%, Microsoft's down 0.2%, Amazon's down 1.2%, Meta was red. It since went green marginally, up 28 cents today. Google is up 1/3 of 1%, but this is what you would expect heading into the Fed cutting rates. Again, because rate cuts do not act as a tailwind for big tech. They actually act as a headwind, as these companies will take in less free interest from their cash in the bank. So as I've said before, whether you're bullish or bearish, I clearly don't care. Come to your own conclusions. The last place I would want to be is big tech. And I've said this for many weeks now, if not months. Even if we get a bearish reaction in markets, you want to be in your interest rate sensitive stocks. You want to be in small caps. You want to be in value. You want to be in dividends. You want to be in cyclicals and consumer discretionary names. But that's obviously just my opinion, and who knows? Maybe big tech goes to the moon and everything else does well at the same time. But it would seem highly unlikely that big tech outperforms in an interest rate cutting regime, especially if we do avoid a recession. Now, heading into Wednesday, the biggest event we've had in many years, retail sales tomorrow morning is the only other thing that will move the probabilities for 25 or 50 basis points. Okay, let's imagine this. Imagine if the Fed is dead set on 50 basis points. Imagine if, no matter what, they want to do 50 basis points. If, well, the Fed made it clear that they get important data, especially during their blackout window, you know, data, let's say CPI comes out, a big CPI report the day before the Fed makes a decision, you know, that can obviously weigh on what choice the Fed's going to make. That's why the Fed gets data first, right? They get it a day or two, sometimes a couple of days early. So Powell knows what retail sales are tomorrow morning. He already knows that right now, okay? Because their Fed meeting starts tomorrow, and that's important data that they need to discuss. So again, imagine if the Fed is dead set on 50 basis points. But imagine, like what's going on right now, there's a 60% chance of a 50 basis point cut and only a 40% chance of a 25 basis point cut. Nick Timmerhouse's article last week did a very good job of getting markets ready for a 50 basis point cut. But imagine if retail sales come in really strong tomorrow. The odds of a 50 basis point cut are going to plummet. The odds of a 25 basis point cut will go over 50%. And then if the Fed does a 50 basis point cut, they're catching markets by surprise. Again, the Fed, let's say they're dead set on a 50 basis point cut, then you need to see another article from Nick Timmerhouse that comes out at least by tomorrow afternoon that says the Fed's probably going to do a 50 basis point cut to price that back into markets. Now, if we don't get anything from Nick Timmerhouse, that's probably because retail sales came in on the low side, which will further solidify a 50 basis point rate cut. Now, as far as retail sales, this is a month-over-month reading. So last month, we were at 1%. You're expecting 0.2% positive. That's actually pretty strong if last month was 1%. Now, if you come in negative, then Wall Street's going to look at that as that's a weak report, right? And you're obviously going to get some revisions as well that will affect things. But as they stand right now, we are expecting a pretty good number for tomorrow's retail sales. If it comes out on the low side, that's positive for that 50 basis point argument. If it comes in high, if it comes in good, that's, well, not going to solidify that 50 basis point cut. And then at that point, I would expect an article from Nick Timiraos coming out probably after retail sales. I actually think there's a pretty good chance retail sales comes in on the strong side, and then we get a new article from Nick Timiraos that pushes the odds back in favor of a 50 basis point cut. So I actually think tomorrow is going to be a very volatile day for markets. Now, the percent of stocks currently trading above their 50-day moving average is up 0.34% today. So about a third of 1% of all stocks are breaking above their 50-day moving average today. At one point, this was over 2%. So it's not as good as it was earlier in the day, but it's still positive. CNN's Fear and Greed Index is sitting at 49, which is neutral, the same as where you were on Friday. You were also neutral with a number of 49. And here you can see hedge funds piled into shorts against stocks for the 5th week in a row last week, as per Goldman Sachs. Goldman Sachs also continues to stick with their call for only a 25 basis point rate cut at the Fed's September meeting on Wednesday. They do expect a 0.1% increase in core retail sales in August, but they expect a 0.3% decline in headline retail sales, reflecting lower gasoline prices and lower auto sales, which, if retail sales again comes in at 0.3% negative, you are going to see the odds of 50 basis points get heavily priced into markets, probably somewhere around 80%. That would mean the Fed's going to do 50 basis points. They also say our forecast reflects mixed card spending and a moderation from very strong growth in core retail sales over the prior 2 months, but a potential boost from back to school shopping. So let me know what you think about this information down below in the comments section. Hit the like button as well as subscribe to the channel if you have not done so already. If you learned something or like a different perspective than perhaps what you're going to hear from Wall Street. You guys have a great rest of your day, most importantly, and I will see you in the next one.